Today we're looking into the topic that's crucial for entrepreneurs out there and investors, property investors especially, and that's understanding the UK property tax landscape. Big topic, but I'm going to keep it very simple and focus on a few things. Now, whether you're renting out a property, flipping houses, or holding on to investments, this video is for you. First, let's establish the difference between property investors and developers or traders. As an investor, you're typically holding on to properties for rental income and therefore also looking for capital appreciation over the term of ownership. And if you're a developer, you're often buying, renovating, or building to sell. And each of those two routes has its unique tax implications, because one is going to be an investment business, which is buying and holding, and the other will be a trading business, buying, building, selling. Now, for property investors, remember, your rental income is taxed like any other business income and at the same rates. But here's the good part. You can claim certain costs to reduce your tax bill, and that's important. There are plenty of expenses you can claim. The common ones are maintenance, operating expenses, mortgage interest, depending on whether you own property in your own name, partnership or limited company or LLP, and everything else that is used wholly, mainly and exclusively for your business. However, it's also important to note that investment properties usually don't qualify for entrepreneurs relief, which is now called business asset disposal relief. Turning to our developer friends, your scenario is different. The profits from selling your properties are treated as trading income. This means they're subject to different rates of tax and rules compared to rental income, in a sense that depending on whether you're a sole trader or a limited company, you're going to be paying tax, and how much money you make obviously will determine the rate you pay, especially if you're a sole trader, because there are different bands. And remember, each development project could have different tax implications depending on what you're building and how big the development is, the profits, so on and so forth. So with all this in mind, how do you manage and reduce your tax bill is the question you probably have on your mind. For both investors and developers, planning is crucial and key. Do not underestimate this, and you have to do things before the event. Consider setting up a structure that suits your needs. So that could be a limited company, a limited liability partnership, a sole trader, a standard partnership, and it depends on your goals, aspirations, and your exit strategy, among other things, in terms of which structure to use. And you could use all different structures, by the way, based on the type of developments and projects that you're doing. So you don't have to stick to one. You can use them all if they work for you. And as you can see, there's a lot to unpack, and it's crucial to get it right. If you want me to do a deep dive on this, let me know in the comments below. As always, I recommend and highly recommend that you consult with a tax specialist who can give you tailored advice based on your situation and scenario. So that's it for today. Hopefully this video has helped you raise your awareness to some extent, and there are numbers of ways to reduce your tax bill, whether you're trading or investment. If you want more information, contact me. I'll be more than happy to help.